All right. Well, hopefully everybody's made it through Thanksgiving. I don't mean to spoil your week, but this ought to be fairly reasonable. What we're going to do is we're just going to review the course in preparation for the final exam. As you know, final exam will be done through UA Learning, so you'll be using the RP Now system. So again, I regret this course is being taught through distance. It's kind of tough. It would be, more interesting to get questions and feedback as we go, but it is what it is. So we're all in for some challenging times financially as things go forward. You guys probably more so than I am, hopefully. Anyway, good luck and hope you do well on the test. In terms of the final paper or the homework, all those submissions, get them in prior to starting the final. So your term paper, turn that in prior to that. The rest of the homework, and good luck. And we'll jump right in. Okay, so when we talk about insurance, there's different terms that are used. One of the terms is the beneficiary. The beneficiary is in the case of life insurance, it's obviously not you, right? You're dead. So it is the person who's going to get the proceeds. So it doesn't need to be one person. It doesn't even need to be a person. I mean, it can be some charity or something. But anyway, whoever's named or whatever entity is named is the beneficiary, and they're going to be one getting the proceeds. Um, we talk about bonds again. I don't know that I didn't talk about bonds that much. If remember a corporation or even a municipality, sometimes they can't sell stock, so all they can do are bonds or perhaps get a loan from somebody. But anyway, a bond is just not really a loan that is typically offered through an institution, and a bond would say, give you something like you would give them, you as the bondholder would give them, say, 20,000 bucks or whatever, and they would start making payments to you. And at the end of the period, at the end of the maturity of that bond, they also give you your money back. But guess what? Knowing what you know about time value of money, that money is not worth what it was when you gave it to them. Hopefully, the money plus all those bond payments is worth that. And if it is, then you made a good investment. But you had your money tied up. Now, sometimes companies will do a thing where they can convert, um, a bond to actual stock. Now, if you own stock in a company, that is not a loan. You own part of that company, and it's makes some bit of difference if the company happens to go out of business. If it's stock, yeah, it's not their problem. The fact that you own part of the company, you're in on it just as much as they are. Your company went out of business. So if you had a bond, well, you'd made them a loan. So maybe they can split up that company and whatever assets are left. But if you're an individual investor, good luck. You're not in a great position anyway. So either, if you think a company is questionable, and again, there's bond rating agencies that do that. Um, why the dogs decide to fight every time. Anyway, the joys of distance education. We'll see if it continues. I may have to put them away. Anyway, if a bond can converted into stock, it would be called a convertible bond. So that's the notion of the question. If you have a bond that could be called, what happens in a call feature is essentially they set bonds at a certain interest rate, trying to make them attractive to the market. If they guess wrong, if they're paying you more interest than they feel they need to, if your bond dividend is higher than what the market is bearing, if they could sell new bonds to somebody else, they might decide to call your bond, which means, if you gave them 20,000 bucks and you're expecting a series of payments and then you're 20,000 back at some point in the future, they might just say, "Hey, here's your 20,000 back and all future bond payments are suspended." The deal is off basically. And if that's one of the reasons I wouldn't want to be involved in bonds, specifically one with a call feature, because they're kind of holding all the cards. If interest rates go higher and they were forced to issue new bonds, well, they're not going to do that. They're going to hold you to those terms. So pause this for just a second. All right. So next question. Let's say you have some sort of contract. In this case, it might be an insurance policy, but it can be any contract. A rider is an attachment, and sometimes there's different. Sometimes they call it a codicil if it's a will. Anyway, a different addendum, a different document or an additional document. In this case, though, the word we're looking for is rider. It's a attachment to a contract. I used to work in concerts, right? And back in the day, I mean, there's some famous, whatever bands that had different contract writers, famously specifying how, things needed to be done and, the color of M&Ms and all that other silly stuff. Anyway, it was basically a thing to make sure that people who were putting on a concert had read the contract, and it was a legal document. I mean, if you signed and you agreed to specify things within that contract, you were bound to do that. Anyway, this is the same principle here. So if you have where it becomes a factor in an insurance policy is you don't want things to be vague, right? And this would be the case if, let's say, you assume that they're going to cover this item that you have. Let's say you have a bunch of jewelry or guns or photography equipment, and you think, well, I've got homeowners insurance, so all that stuff was in my house, so I'm good. Probably need to read the fine print. There's probably a limit for specific categories where you would be essentially out if those products were destroyed, stolen, whatever. So if you have something, if you fall in that case, you want to make sure that you've had annotated those, probably in a separate document that's attached to that insurance policy. And anyway, taking a long way to get here, but that extra document would be called a rider, contract rider. Mutual funds. So mutual funds are something that most of you will end up owning at some point. Typically, that not always, but typically they're made up of individual stock positions, and it's used for a variety of things. One is just the ease of purchase and transfer and the rest of that. And there's also some diversity since you own a range of companies. If a single company goes under, you're not left holding the bag. The odds that a whole sector is going to fail are quite unlikely. So anyway, because you're going to be owning these mutual funds, the most preferable type, because it's a competitive market out there, are no load funds, funds that don't have a commission charge. You can find funds that have a commissions charge, but that is not a good idea because you're needlessly paying a commission because the competition. There's tens of thousands of mutual funds out there that don't charge a commission. And keep in mind, knowing again what you know about the time value of money, if you're paying a commission, that's coming out of the front end. That's coming out of that. Let's say you're only putting up $500 a month or $50 a month or whatever. That initial money that's going in there is the money that's going to be worth a tremendous amount in the future because it's going to be given the longest time to build. So if they take, say $1,000 commission out of the front end, that's going to cost you tens of thousands later on in life just because of where it's taken. So anyway, if you're buying a mutual fund, look at the expenses, look at the fees, make sure they're reasonable, and make sure it's a no load fund, a non-commission fund. Mutual funds can be structured in a bunch of different ways. They can be, in different asset classes or different sectors of the economy. They can be in, say, technology, medical, military, whatever. They can be geographic. They can be investing in certain areas or certain regions that have something in common. Or a lot of times they can just be more generalized. They can be, say, a growth fund. A growth fund would be one that you're looking for something that's probably a smaller company. And a smaller company, they define that as capitalization. That's how much money that company is worth. So small caps, are probably more aggressive than obviously large caps that are more established. But anyway, the key operative word that you're looking for in this question is growth, because that's going to be, a rapidly growing corporation with a higher than average revenue and earnings growth. A lot of times, though, earnings growth is they may not be paying the earnings right now. In fact, they may not be paying earnings or making any money right now because they're focused on growth and they're reinvesting that money. So earnings are important. Profit may not be a big deal right now. Anyway, a mutual fund that invests in common stocks of companies of the same industry. So I kind of referenced that before. That would be a sector. So, medical sector, um, defense sector, technology sector, biotech, whatever. You can get down in the weeds as far as you want. This is so other funds, as long as we're here, let me just run through a couple of growth income. Growth and income that's kind of a hybrid. A growth fund typically doesn't pay dividends, which are typical of an income fund. So can't come to, I mean, that would be maybe a company that's mature, that's starting to pay a dividend. But anyway, it'd be a larger company, not necessarily a small one. An income one, this is a company that's going to be larger, more established, maybe not focused so much on growth anymore, but focused on paying a dividend. Small cap, that refers again to the capitalization. So just like there's small caps, there's large caps, there's mid caps, and there's actually numbers that go along with that, in terms of $1 billion in assets and stuff. And then there's also a money market. A money market would be just something that's going to be holding government treasuries, something that's just sort of a parking place. It's not going to be keeping up with inflation. It's not going to be a long-term investment because your buying power, and believe me, your buying power now more than ever is going to be, frittering away. You're losing about, well, I don't know, I would guess about 7% a year or so if you just got your money held in there. Now again, you put 100 grand in there, you'll still have 100 grand at the end of the year, maybe 101 or something like that. But what you can buy with it is not what you could have bought with it a year ago. Now it's going to be about what you could buy with 93,000 a year ago because of inflation. Another question on mutual funds. So what do they do? Is a way of investing in a single stock? Absolutely not. No, it's a range of stock. Is insured by FDIC, Federal Depository Insurance Corporation? No. No, stocks and things like that, those types of investments are not insured by the FDIC. Do I worry too much about that? No, because you can't. Because if you want to put it in something that is FDIC insured, um, you're you're not going to get anything that's going to keep up with inflation. Is a form of indirect real estate investment? No, not typically. Although there are some mutual funds that do hold real estate positions. It's professionally managed, so investors need not monitor the fund results. Eh, you don't need to monitor every transaction, but yeah, you do need to monitor the fund results. So I'm going through some of the bad answers here. The correct answer in something like this would be pools the money of many investors, right? It's a group, and then you become, shareholders to that fund, and they try and do it in a variety of securities. So, um, let's say this gets back to an insurance question. Maybe we didn't talk about this too much, but we'll talk about it here. Let's say you've got, a bad seed. You've got a child that is not quite there, but he's your child and he's a minor and he goes off and has a big party in some house that they break into. Can you just say, well, that's his business? No. Vicarious liability is going to mean that you're responsible for the actions of that minor. So it may fall back upon your homeowner's insurance or whatever. I had a silly pig that went off in the road and got hit by a car, and they, were telling me I was responsible for the actions of my pig. Yeah, it didn't go quite that far, but it can definitely you can bear uh, responsibility for the actions of others, to include pigs, I guess, in this case. A request that a stock be bought or sold at a specified time. So when you're buying and selling stocks, in fact, I just got involved in this today. I was trying to buy some stocks when the market dropped on Friday and the market's closed. So I put in those orders, but the market was not open the whole day, and so they went into limbo. So I went ahead and canceled those. I don't want open orders when I don't know what's going on. Um, if I left those orders in there when the market opened on Monday, they would be uh, declared market orders and they'd be executed at whatever price is out there. Ooh, that's not exactly what I want. I don't mind doing a market order, but I do want to know what the price is right then. Um, and then there's some other orders you can do. You can do, well, we'll talk about one right now, a limit order. So in this case, a request that a stock be bought or sold at a specified price would be a limit order. So let's say the stock price is bouncing around, you know, 90 to 95 bucks. And, right now, and you're a busy person or whatever, you don't have access to instantly sit there and watch it and act upon it, and it's going to bounce right probably back down to 90 at some point, even if for a fraction of a second. You could go ahead and put a limit order in there and put a limit order to buy at say 90 bucks. And when the stock price drops, your limit order becomes an executable order and will try to be filled at that price. Now, you are signing up for a certain amount of variance in that, but it's not really a big deal on a popular exchange because there's enough volume there. Theoretically, let's say in this case, um, the stock price jumped down to 90 and kept going lower. There's a chance you might be able to buy for lower, but probably not. Most of the time, with the volume, with the speed of the exchanges, not a big deal. Where this might become more of a factor is, let's say you've got a stop loss order, so different than what's addressed in this specific question. But let's say you've got a stock that is going up, and you don't necessarily want to sell right now. You want to try and maximize your profits. So rather than sell right now, you expect it to go higher, but if it happens to dip lower, you want to get out. You want to um, you know still retain some of that profit. So let's say it's at $95 right now, and you expect it to go higher, but again, you bought it for say 70, and you don't want it to drift all the way back down to 70 in case you're wrong. So you put in a stop loss order, which would sell it at say, you're going to pick a price here. So let's say you're going to pick $90. You wouldn't want to pick 95 because boom, that's going to execute right then. You wouldn't want to pick 94 either because a little bit of volatility, just normal price volatility, and you'd be stopped out of the market. So you pick 90 in this case, and again, that's up to your own wisdom, whatever you come up with. But 90 would be fairly logical because then if it's going to hit 90, it's actually making a fairly steep move to to the negative, and it may continue on down to 70, which is at worst case you're not, definitely not the worst case, but the case you're not looking for, where all your profits are raised. So anyway, you do this. You set that $90 stop loss order, and the price drops to 90. And once the price hits 90, your stop loss order becomes an executable order, and boom, it could fire off. Now this is the case where, let's say, it's a very slow traded stock, or something like this where it's a weekend and there's low volume, extreme low volume, and it opens on Monday and opens sharply lower. You could sell for, let's say, 85 or 87 or something like that, which is not your intent. But there just weren't any other trades between when your $90 stop loss became executable. So anyway, you'll see these warnings on when you go to trade stocks with stop losses. And but like I say, in most cases, if you're trading Tesla or AMC or most stocks, there's such there's so many trades out there, so much frequency, um, that it's usually not an issue. Although if it's going to happen, it's going to happen on a day like Friday with very low volume and shortened trading hours. That's what happened to me. That's why I had to cancel those orders. Stock that sells for less than $1 a share. That's called a penny stock. And it's also not really called investing in my mind. Penny stocks, because of that, they're probably not listed on the stock exchange. The corporate people probably are not, registered with the SEC, and they can say some stupid things and do some pump and dump stuff and do some Wolf of Wall Street tactics, and you probably need to stay away from them, especially in the internet age. I mean, you are trying to be scammed. Everybody's trying to scam you left and right, and penny stocks are a great vehicle for them to scam you. So, um, system requires an insurance company. So what happens is you have insurance companies, and let's say an insurance company wants to operate in the state of Alaska, and insurance is done on a state by state basis. And let's say this insurance company is like, yeah, we want only drivers in Alaska who don't get in accidents. We want just the cream of the crop, and all the drunks and all the people out there with bad driving records. Yeah, we don't want to insure them at all. And it doesn't really work that way, because what would happen is all those folks who do have bad driving records but are still licensed drivers, well, they still have a legal requirement to have insurance. And so they make it a condition of doing business in the state that these companies, when they come into the state, they have to take some of these assigned risk pool drivers. Some of these, and in Alaska they have whatever SR22. You'll see this on certain things where people would have a very tough time getting insurance, and so they force the insurance companies to insure some of these guys. Now they don't force them to give them a great rate. I mean, they can still charge them considerably more, but they do have to provide insurance, because otherwise you'd have all these uninsured drivers driving around out there. We've talked about wills before. What is a will? It's a legal declaration of a person's mind as to the disposition of his property at his death. So a lot of things a will is not. I mean, if it's people will say, well, there's a whatever will, a verbal will, or a holographic will, or all these stupid terms there is only one will. The only will that's legally enforceable is one which is in accordance with the state's rules for probate. It's going to end up in whatever state you're in, it's going to end up in their probate court. And if it does not comply with their legal requirements, it's not a will. So you want a will. If you die without a will, you die intestate, and that's not a good thing. All right, so there'll be some questions on the exam relating to stock purchase type things, and really any investment purchase. There's a term that you know from this course called capital gains, right? If you buy something and then sell it for more later on, you have a capital gain. And so that money is taxable. And remember what we said, there's short-term and long-term capital gains, defined as short-term less than a year, taxable at a higher rate typically because it's taxed at regular income. And then we have long-term capital gains, which are taxed generally around 15%, and they're held over a year. So if you're given a problem about, say, a lady buying some shares, you figure out how much she bought them for, how much she sold them for, and then you come up with a amount of capital gains. Also, if she was, in this case, I'll just say it, silly enough to pay a commission, well, that would come out of the profits as well. But again, just like no load mutual funds, if you're paying commissions, you're kind of a sucker. There's no need to pay them because, you can buy them through any one of a number of brokerages without a commission. But anyway, let's say if you did pay a commission, that would be subtracted out of there. Let's say you were able, it was an income um, stock, a stock that was paying a dividend. That means that you're getting these, payments every time they have a dividend distribution. So let's say you made $10 per share and you had it for 3 years and got, some money each year in terms of a dividend distribution. Well, that would also be added to your capital gains. So it's all good. Now, one thing while we're on capital gains, it's not on this question or on this test, but capital gains in, say, the stock market or basically any investment other than real estate, are going to be subject to either short or long-term capital gains. Real estate, though, if it's owner occupied, so we're not talking, your rental real estate, unless you decide to move back into it, you have to live in it 3 out of the past 5 years in order to qualify. But if, let's say if you do live in it for those number of years, then it's considered owner occupied. You don't pay any tax on capital gains. So again, I've had friends who have done this. They've, had some starter home and anyway, they decided they wanted to sell it, but they realized the amount of money that home had appreciated, and they went ahead and moved back into it. And it was a little podunk house, and they were quite wealthy at that point, or at least. But anyway, they were having some financial difficulties, and they wanted all that money tax free, so they went ahead and moved back into that house. Anyway, most people won't go to that extreme, but if you are going to rent something, and let's say it's getting to the point where you've had renters in it for a significant period of time, greater than what's going to be allowed on the capital gains rules, you might even consider selling it. But anyway, a lot of things to think about. But again, that's a perk of real estate, and it doesn't exist for other investments. Okay, so here's a guy talking about investing in high risk, hopes, earning a relatively large profit in a short amount. That's not so much investing, that's more into speculation. So things that are not those types of things, a treasury bill, no, that's kind of a parking place. That's like a money market fund. That's just a government security. Certificate of deposit, same thing. Low growth stock, anyway. Um, you don't necessarily see people going, calling their stock low growth. They'll try to characterize it some other way because nobody wants, crummy performing stock. But there's certain, a lot of times the income um, stocks will a characteristic will be low growth, but they're not going to highlight that. They're going to highlight the fact that they're paying a dividend in compensation for being low growth. And then low risk bond is another bad answer, but again, low risk bond would not, everything's risk and reward. If it's a low risk bond, then it's going to be a low return bond. You're not going to be getting, um, you know, hopes of relatively large profit. Nope. The one that this guy would be looking for is a speculative stock. So again, try and separate speculation from investing. Again, I speculate all the time, but I try to not do it with major chunks, not, your nest egg. You don't want to be speculating. And I don't know, but we'll see what happens with Bitcoin and the rest of that. That's kind of converting from a speculation now to, at least in Bitcoin proper and maybe Ethereum as well, as being less speculation and more investment, especially as the government debases the dollar. So we'll see. Okay, this lady, she's paying. This is an insurance question, right? So if you go to the insurance for some medical procedure, or more likely maybe in an auto situation, and you crash your car, and the damage to your car is say $6,000, and you take it in there, and the insurance company cuts you a check for 5,500. Why did they do that? Because you had a $500 deductible, right? And so a lot of times you'll have different ways. But insurance companies are very keen in knowing or wanting you to at least feel some sort of pain for filing a claim. They will definitely create some pain on future premium increases if you're filing lots of claims, but they do typically have a deductible to give you some immediate pain right up front to where they're trying to make you be more careful. But anyway, if you want a low deductible, 100, 200, something like that, yeah, you expect to pay quite a bit more for premiums. If you're concerned about insurance and you're fairly cautious, $1,000 deductible is completely reasonable. So anyway, well, reasonable as long as you got $1,000 to put up in case of something bad happening. But I think you would probably prefer that if it's reflected in a much lower premium. Okay, so this is a question that kind of relates to gold, and they're talking about international tensions or disinflation is said to cause gold prices to decline, right? Gold, the way gold is supposed to work, and the way it works on this test, is that gold is supposed to be a hedge against inflation, and a hedge. Well, it's supposed to, when things are going poorly, gold is supposed to rise in price, and that's the way it's been sold and gone on for a long time. And there's people who would consistently argue that to this day. In some cases, this is mitigated a bit because some of the precious metals are also used a lot in industry, and so gold and silver, when the market goes down, demand for gold and silver sometimes also goes down due to its industrial uses, industry being slower. So, and we'll see what happens. Gold is definitely underperformed that I talked about in the investment video, but anyway, the overall reason why people typically invest in gold is because it's supposed to go sort of the opposite. When things go bad, it's supposed to go up in price. In this particular question, it talks about easing of international questions or international tension and disinflation, meaning inflation's going down, which is not a scenario we're in right now. But anyway, if that were to happen, gold prices would decline. Let's see. All right, so estate planning. What does estate planning deal with? Pretty much everything. I mean, it's more than just, it's beyond retirement, right? Typically, estate planning deals with you after you're gone, but there are some management things in terms of how you want to set your property up and things like that when you're actually alive, so that it can be passed most easily. So your property after death, managing your property when you're alive, financial security, obviously upon your death, and then your spouse's death. So one of those all of the above type questions. If you're using leverage means using borrowed money for investing. So most of the time that's not a good idea, because anyway, you can lose far more than obviously you're borrowing money to invest. You're using more than you have available. Now, that being said, if it's real estate, that's commonly the way things are done. You do use mortgages and things like that. But for stock market type things, that's what they call buying stocks on margin. And because of the margin requirements that I talked about earlier, it can force you into some positions where your assets are sold kind of out from under you because you can't make a margin call. You can't, in this case, because they calculate your collateral on a dynamic basis, meaning if stock price drops and the stock is actually the collateral for that loan, they can force you into a sell position. So anyway, if you hear anybody talking about being leveraged or over leveraged, they're referring to investing with borrowed money. Average individual dealing with retirement. What typically things, or what are some of the typical statements? Um, Cost of living decrease significantly once you retire? Not necessarily, especially in the medical realm, or especially if you want to enjoy yourself and travel. I can only expect to live about 10 years in retirement. You don't know how long you're going to live, and people life expectancy, for most people who are short of drugs and other things, the life expectancy is always going up. Medical bills always paid by Medicare? Nope, not the case. And your pension plan will provide all your retirement needs? Probably not. So anyway, one thing that's always true is whatever's available, whatever amount of money you can put aside for retirement, um, even if it's a small amount, save whatever you can. Here's another sort of insurance question we talked about. Maybe back to the first question where I was talking about a contract writer, insurance policy writer. They also will refer to that as a personal property floater. Same sort of thing. Um, Here's somebody who died without a will. Remember what we talked about there? That's intestate. So I don't know how it is at your house, but it's minus 18 at my place. And so my dogs are not happy that they're not outside. So apologize for the extra dog noise today, but that's kind of the cost of a midwinter cold day. Okay, so this guy has a bunch of assets. Um, he's got a will. Um, where's this all going to be processed? Where do all legal whatever, where do they take place? They take place in probate court. If you ever hear probate court, that's what they're talking about. They're talking about the execution of wills and other things dealing with that. So, typical terms that you're going to learn. But probate is a state court, so you can't. If you have a will and you go to another state, you need another will. If you stay in the same court or same state, you stay in the same court, and so you're good, unless your life changes dramatically. But again, if you write a fairly general will that expresses your wishes, it's important to have a will, but you don't need it down to you know uh, incredible specificity, unless you really need to, because you're going to be generating a will that's going to need to be changed quite often if it's too specific. But it is important that you have a will, just for expediting the processing and getting the money to the beneficiaries, once that whole thing's done. Anyway, this is a lady. She's going to retire in 2050. So a lot of times, like we talked about with mutual funds, you have different types. You have some that are aggressive, some that are less aggressive, some that are just say less aggressive to the point of just being income funds that just pay where you're not really concerned with growth and they're just paying a dividend, and your money's not really going to appreciate that much, but you don't want to be involved in any sort of risk. Well, the mutual fund companies, being who they are, and wanting to market and sell people different products, they've come up with life cycle funds. And so you've probably seen this when you're looking through, your in preparation for the paper. Life cycle funds would be funds that, um, as you're way far out from retirement, they'll probably be in aggressive type funds. As you get closer to retirement, they'll be switched to income funds. But anyway, they'll manage that, and they'll manage it based upon a prospective date for retirement. Anyway, those are titled life cycle funds. Interest rates and bond prices. So I keep talking about how I don't like bonds. Well, the reason I don't like bonds is because we've been in a low interest, um, realm for quite some time. And so interest rates can really only go up, and actually they're starting to go up, but they're not quite there yet. If you were holding a bond or buying a bond right now, probably wouldn't be a great idea to be investing in a bond right now, because let's say the bond company is going to pay a 5% dividend. Well, odds are next year they're probably going to have to pay a 6 or a 7 or 8% dividend. So that's why bond yields and all that are dependent upon interest rates, because they will change in relation to interest rates. And you don't have to hold a bond to maturity. You can sell it on the open market at some point beforehand. And so let's say you have a $20,000 bond, but it pays 5% and the prevailing rate is now 8%. Well, you go to sell that $20,000 bond, somebody, whoever wants to buy it, is probably going to pay you maybe 18,000, 17,000 because it's not worth as much because there's competitive bonds out there paying a higher interest rate. So anyway, in this nature of this question, if the interest rate in the overall economy decrease, so not quite the situation we're in right now, what will happen to the market value of a corporate bond with a fixed interest rate? The value of the bond will increase, right? So let's say you're in a situation where you're getting 8% on a bond, and next year the bond rate, for new issuances is only 5%. Well, your 8% looks better, so they'll pay you more for it. But that's not the situation we're in. So anyway, but that's not the question we have. So read the question and look at it and think things through. Um, if interest rates in the economy rise, again, same sort of question. So if you understand it, you'll get two here. Uh, if interest rates rise in the economy, corporate bond with fixed interest rate will decrease in value. So same. I die without a will. Again, your state laws of descent and distribution becomes your will. And again, you go to the bottom of the pile, things may not turn out the way you want. Lawyers have to be involved, so they're going to take their money too. You just created a mess for your heirs, for the beneficiaries. Illiquidity in real estate. Illiquidity, remember that? Liquid means you can just grab it. It's like cash or cash equivalents. Um, illiquidity means, in this case, you cannot sell the property that quickly, typically. Any real estate transaction is still going to take a while. Stock, couple 3 days for settling time. Crypto, instantaneous. What do you call it? Cash, even more instantaneous if that's a thing. But anyway, real estate transactions are slow and tedious, and therefore those things it's considered an illiquid asset. Okay, here's one about life insurance. How do you determine how much life insurance you need? But you figure out how much you're going to be missing. How much was the breadwinner? How much of that money is going to be gone? Okay, here's another one about a stock price, bought and sold. So another easy one if you understood the first one. Just subtract the two amounts and do that. Okay, this one, he wants a diversifier portfolio, potentially earn above average profits. So that's going to be a growth stock. Here's some other stocks they have listed in there. A defensive stock, that's not going to be a high yielding stock. And again, these are marketing terms, so you have to do your due diligence and figure out what's defensive, what's not. Cyclical stock, probably something in the energy sector. Those things do tend to cycle up and down. Small cap, that refers to um, a company that's got a small capitalization, but it can be a small, plumbing company. It doesn't mean it's a huge growth company. It just refers to the capitalization. Blue chip stock, that typically refers to a big company, but maybe where you want to be, maybe not. GM, Ford, big companies that are kind of well established, but maybe they're grain. So in this case, this person, he wanted that higher potential. So that'd be back to the growth stock. Again, I keep talking about growth stocks, but if you're young and you got time for your money to earn and you can handle some volatility, growth stocks are probably where you want to be. This guy bought a car. He's got airbags and other safety features. What's he doing from an insurance perspective? He's not avoiding the risk. He's not pretending the risk doesn't exist. Um, in this case, he's not necessarily turning it over to the insurance company and having them assume the risk. No, he's reducing the risk. So that's a risk reduction measures. Life insurance premiums, how are they determined? By mortality tables. Tables that tell basically, given your lifestyle, what are the odds you're going to die? When are you going to die? Pretty grim. This guy, again, he's looking for long-term investments. He's young. Which of the following? He's going with growth stocks. Um, why do people get most of their health insurance through their employer? Because they're typically, they have higher buying power. They have diversification of risk. So most health insurance is usually purchased through employers, the vast majority in the United States. Here's a question about what investments get on average 10% per year. Stocks, right? T-bills, no, they're not going to get anywhere near 10%. Bonds, no, they're not going to pay that much either. Options, a whole different animal. Zero coupon bonds, just a distractor in there again, another investment. But anyway, they're not going to pay 10%. The stock market is the only investment that is typically capable. Not the only, but one investment that's capable of and has a track record of 10% per year. Investment company. Let's say you're going to buy a mutual fund. You do have to look at a thing called a prospectus, and the prospectus are kind of the rules of road for the fund manager. So if you ever go to buy a mutual fund and it says, okay, before you buy this, this is not true with stocks. You can buy some company and know nothing about it. But mutual funds, because they're sold typically to retail investors and people who may not be, that experienced, you have to acknowledge that you've read the expectors. And it's not like an end user license agreement. You should actually read the thing, at least read most of it, and make sure that that's what you want to be involved in. Here's just defining inflation risk. When an investment does not keep up with prices that are increasing in the overall economy. Yep. So, even though your investment is going up by, 1% a year, if inflation's 7, you're screwed. An annuity. In this case, annuity, sometimes people get more involved, but annuity just means a series of equal payments. When they're talking about it with insurance, it's sort of the opposite of life insurance. In the case where you give them a certain amount of money, let's say you give them $10,000 and they start making, $100 per month payments back to you forever for the extent of your life. That is an annuity. Here's a lady, she bought some stock, and you'll see this. You don't typically see this in mutual funds, but let's say you bought some stock. Well, now you have an ownership position with that company, and so when there's shareholder meetings, they're going to send you a form to vote on things. Now, keep in mind, this is not it's democracy to the extent that one share, one vote, not one person, one vote. So you with your 12 shares versus some retirement fund, institutional investor with, 1 million shares, they get 12 million votes and you got 12 or whatever. So you may not really want to, they're not going to invite you to the shareholders meeting, but what they will do is send you a proxy where you can assign your votes to somebody else. And that way it suffices for their legal requirements. This guy, he's making $3,000 a month, and he's setting up all his bills, but he's also setting up his investing as a regular expense. What's that? What do we call that? Paying yourself first, right? When you at the first part of the month, whenever you get your income, you don't rely on saving what's left over. No, you take your savings investment amount out at the front. This guy, he's contributing to a plan, and the employer has a match, and so he puts up 5%, and the employer puts up 5%. Yep, So that's an employer-sponsored retirement plan. So anyway, if you ever have a match involved, make sure you take care of that. Back to insurance. Um, if you have a situation where, getting back to my pig thing, they were trying to claim that there was some negligence on my part, that I knew the pigs were getting out. Not so much. Anyway, um, if you're viewed though, if they can characterize you as being negligent, failure to take ordinary and reasonable care, then you can be held liable to a higher standard. So you don't want to be determined negligent. You don't want to be the person that's got a swimming pool with no fence, or somebody with a yard filled with all sorts of sharp objects, a couple inches under the snow, and the UPS guy comes up and hurts himself, and now you got a lawsuit, and they determine you're negligent. So don't do that. Advantages of being a limited partner in a real estate transaction is that you have limited financial. So if you're a limited partner, yeah, you have limited liability, limited financial liability. So if you ever hear being involved in something and they want to make you a limited partner, know what is meant by the term limited. And limited means limited management, limited. You can't get actively involved in that investment and tell them how they should be doing things, because then you violated your limited status, and you could be on the hook for additional sums of money greater beyond what you have invested, because you've disregarded your limited status. Another thing with insurance, when we talk about a peril, let's say some goofy guy comes to your house and they're trying to sell you cancer insurance or something like that. You can visualize cancer, and that maybe your family has a history of cancer, and you're tempted to buy cancer insurance. You don't want that. No, you want all perils. Cancer would be one peril. In, like, let's say in a homeowner scenario, um, they want to sell you lightning insurance. No, you want lightning, fire, flood. If you're in that situation, you want insurance that's going to cover you in all type things. All is that your roof is gone. Was it the wind? Was it the rain? Was it the tornado? You don't care. You just know that you want your roof replaced. So you wanted all perils covered. Now, one issue with this that we talk about with insurance is that flood insurance is a unique animal, because flood insurance tends to affect a large group. It's very rare for, well, not if you live in California, but typically, if there's a fire in a home, it's limited to that home unless it's this wildfire and burns down the whole neighborhood. They may get to that point, but right now it's only with flood insurance where flood insurance cannot be offered by private companies. It's a federal program. It can maybe be managed, or the policies written by uh, individual or processed by private insurance things, but at the end of it, the insurer is the federal government, because of the catastrophic losses that go wider. Okay, this one, she's buying mutual funds. Um, she wants something with a long history of paying dividends. She'd be looking for an equity income fund, right? Equity being that it's a stock fund, income being that it's paying a dividend. Um, Here's another one about negligence resulting in bodily harm are called liability. So, like when you're in auto insurance, for example, if you don't want to have collision, if you don't want to have uh, insurance that's going to cover your own vehicle when you're at fault, you can opt out of that. You can say, no, I don't want collision. I don't want to pay extra. I'll suck it up and take care of my own vehicle. But you cannot do that for not legally. You have to have at least liability insurance to cover the other person's car. Renter insurance. What does that cover? It doesn't cover the structure, obviously. It's not your structure. You're just renting it. It just covers your personal property. Here's one. She's got a coffee maker. She knows that it's not good. Sounds like she's being negligent. Anyway, the coffee maker is a hazard. And if you allow a hazard to exist, then yeah, you are being negligent, but in this case, the answer is hazard, because hazard is the thing that you're allowing to exist. Here's a lady. She's given a big chunk of money. She's going to put some here, some there. This kind of stock, that kind of stock. Keep some in cash. What's she doing? She's diversifying. She's spreading it out. I mentioned briefly how stock markets go up and down. The S&P is one of those indices. It's a collection of 500 stocks, 500 companies, and so that S&P will go up and down as well. And so when you're saying, is your stock, if you say is whatever stock volatile, it's you need some sort of comparative measure for that. And in this case, in stock market terms, they use the term beta. Beta is the stock market or the volatility of the S&P 500 price. So if you've got a stock that goes up and down quite a bit more aggressively than the S&P 500 index, it would be considered a high beta stock. And if it's doesn't move much at all as compared to the S&P 500, then it'd be a lower beta. So by definition, the beta of the S&P would be 1, right? So let's say I think Shopify is like 1.4 or something, 1.1. That means it's 1.1 times more volatile than the S&P 500. If something was a 0.5 beta, then it'd be half as volatile as the S&P 500. But because of the definition of the S&P 500, the beta of the S&P 500 is 1 because it is the definition of beta. Anyway, interesting to know. The ease with which an investment converted to cash is called liquidity. So we've talked about that a bit. Bond rating, again, how good is that company? What's the likelihood of it to fail? How solvent is it? And you're looking for the higher the better. Now, again, with risk comes reward. If you're buying some B-rated bond that's down in the junk range, it better be paying a lot because there's a high propensity that company's going to go out of business. If you're looking for something very safe, you'd want the highest rating, right? And in this case, that's a AAA, all caps. That's the Standard & Poor's highest rating. Legal responsibility for, again, we've talked about liability a couple times here. That's the insurance that you're required to have for auto insurance or also for other things. Another investment question. We've hit those a couple times. Just, bought it for this, sold it for that. How much do you make? Life insurance proceeds. What should you do with those? Well, obviously, we talked about the breadwinner, replacing those costs that were, if it's a breadwinner who passed away who had the insurance. So you can do a number of things with them, but, paying off a mortgage, paying estate taxes, charitable giving, an endowment if you like. Anyway, lots of things you can do with them. Let's say sometimes you get a company and the price is going up and let's say in the case of Shopify, for example, it's trading for like $1,600 right now. That's kind of large. Amazon's whatever, the $3,000 range, I believe. It's just huge for a stock price. A lot of times companies don't like that. They'll go ahead and do a split. It's going to be a 2-for-1 split. It can be whatever number of splits. But what they would do, let's say Shopify was smart in my mind, they would do maybe a 10-to-1 split. And what they do is if you had one share of Shopify and they do a 10-to-1 split, you'd have 10 shares at $160 each. And now you've got, smaller units, and it might encourage more people to invest. But anyway, however they want to do it, it's their business. But when they do this, when they divide their shares up, that's called a stock split. It's indicative of a company that's growing fast, but it's not maybe it's a marketing thing where they want to give the illusion that they're growing fast. You didn't generate any wealth. I mean, if the stock in this case was trading for 1600 and they give you 10 at 160, you haven't generated any wealth on that. But you just broke even in that case. Um, when we get down into junk or things that are below junk, now we're in default. So what happens when a company is no longer making its payments? Like let's say you've got one of these real estate companies in China, like in Evergrande or whatever, and they're not able to pay their creditors anymore. What would their bond rating be? D. They're down in default range, so they're not making payments anymore. Um, Real estate investments. Yeah, we keep talking about lots of good things, but one of the bad things is the illiquidity. Um, we talked about stock prices or stock splits. They don't necessarily generate anything, but they're nice, but the act itself doesn't generate any wealth. Um, Involved in an auto accident. Yeah, just keep your you know do not discuss the accident with anyone around, because obviously you may say something stupid and you may you know say that you're liable when it's later found out there were other causes. So just make sure everybody's all right, but don't discuss the actual factors of the accident. Not a good idea. um, Things about mutual funds that nearly half of all U.S. um, households own mutual funds, more than 12,000 available, and this goes way back by 2009 numbers, trillions and trillions of dollars. So mutual funds, there's more mutual funds than there are individual stocks. So it's just huge, and you will be involved. So I'll just talk about stocks and stuff. It's not, you know, don't necessarily forget it after this class. Now, I'm not saying to go out and set up your own account and start, trading stocks and doing the whole Wall Street bets thing unless you care to do so. But um, you will have exposure to the market probably through mutual funds. There's a better than 50% chance, at least, especially if you're college educated. I would say that that's about 80 to 90%. Which of the following has greatest growth potential? So again, it's not a bank account, not a corporate bond, not a government bond, not a T-bill. Coming back to regular old stock, common stock. Which of the following least liquidity? Again, if you don't know about liquidity in real estate, it's going to be beat down on you in this exam. Another question on that. Which of the following is a true statement? We talked about inflation again. There's always a risk that even though you're making 5%, you think that's great. If inflation's a couple percent more, you're still losing buying power. Um, Term insurance, great way to go, but it's only for a specified period of time. But fair enough, uh, start building your nest egg when you get to the point where you don't need insurance, at least life insurance. Which of the following statements is false? So we've got a few on here, but just because you're buying a mutual fund, the reasons you buy mutual funds are for diversification, management, all these other things. But it doesn't necessarily mean that you're going to make more money. I mean, um, I I make more money trading in individual stocks, but it takes a little bit more time, and anyway, I've got different priorities. Then I'm less risk averse than most of the mutual fund people, and we've been in a bullish market, so it's been rewarded. But anyway, it's tough to say. But for the answer on this question is yeah, investors who purchase mutual funds are guaranteed a higher rate of return than if they were to purchase comparable stocks and bonds directly. No, that is not the case. There's no guarantees anyway. Uh, Here's another one about bonds are a form of debt capital, which I hope you would get right. Stock, not debt capital. Stock is an equity position. Stock must be repaid at maturity. No, bonds are repaid at maturity. Bonds do not have to be repaid. Yes, they do have to be repaid. And then instant payments to bondholders must be. Anyway, just a throwaway bad question at the end. So the one that you need to know is that bonds, yes, that's a debt capital. You are essentially making a loan to that corporation or government entity, whoever's pulling up, selling the bond. Who has the greatest need for life insurance? So is it somebody living alone? Absolutely not. Singles living with their parents? No, not a lot of expenses there. Dual income? No, the other spouse could probably take over. Children? Absolutely not. You see some of these things, it's gruesome, where they're selling life insurance for children. It's a sad event, but man, I don't want, whatever that payment is because my child died. No, the people who need the insurance are the parents of those small children. And then another one about Social Security. You can depend on Social Security uh, to pay your basic living expenses. You can't depend on anything. No, it's false. May not cover your basic living expenses. And then one last one, insurance. Remember we talked about different types. We talked about collision. We talked about liability. And then there's the one that kind of covers everything out there, glass breakage, vandalism, hitting an animal, all those things. That's in comprehensive. So anyway, that's the extent of it. That's going to be the entire exam. Um, Again, use the RP Now system. Go through UA Learning. They're the ones who are going to be holding the test. Hope you got something out of this course. Um, Anyway, not too much else to say. Hopefully it'll warm up here in a few days. My apologies about the dogs, but it's just the nature of being in Alaska when it's minus 20 out. So talk to you soon.